is that as Chinese have moved up the value chain, they are threatening the German business model. Now, looking at this chart of German equipment exporting, you can see that they used to export equipment all throughout the world, but that has gone way downhill. That is Chinese competition stepping up. Now, a good example of this, of course, is just looking at the Chinese car industry. You can see that over the past few years, the number of Chinese cars being exported has absolutely surged, whereas, say, car exports for Germany have basically plateaued. So you're in a situation where, as a country, your business model is basically being overtaken by China. And you also, of course, Euroland doesn't have stuff like AI, which has been causing the U.S. market, U.S. economy to having this big build out and so forth. So as a country, as a region, they have big problems. And one of the things that they're considering actually is to do something similar, basically to erect a tariff wall to try to make their own goods a bit more competitive relative to imports. Now, one reason that this would make sense is that there's a lot of Chinese policy that is supporting the export boom in China, such that the playing field is not completely level. Standard things would go from government subsidized loans and so forth, and all sorts of stuff in China to try to boost their exporting industry, which is a major creator of growth and jobs. But also from a financial perspective, they also are, I guess, managing their currency. So in theory, if you had a country like China who keeps selling a lot of stuff and earning a lot of euros, earning a lot of dollars, trade surplus to the tune of $1 trillion a year, you would expect their currency to gradually strengthen, right? So you're a Chinese manufacturer, you are earning euros, and then you sell those euros for RMB. RMB appreciates, and that would naturally make your products more expensive to foreign markets, and so maybe equilibrate the market a bit. But the Chinese government is, of course, managing the currency such that the Chinese currency is structurally undervalued, and some people estimate maybe 20 to 30% undervalued. Of course, they have $1 trillion surplus. Their currency should be much stronger than it is today. And that could be part of the reason why that the market is unable to equilibrate. Chinese continue to have a great surplus. And if you have government policy kind of making market forces difficult to work, then the response, of course, is to also have a similar government policy. In the US, that was tariffs, and it looks like possibly in Europe, that may be tariffs as well. So